This episode was co-produced by DeepTechNation Switzerland Foundation, a non-profit foundation committed to sustainably improving the framework for Swiss startups, scale-ups, and investors in the deep tech sector. Their goals are to mobilize 50 billion Swiss francs in venture capital and create 100,000 jobs within the next 10 years, making Switzerland the world-leading deep tech nation. Check out how they can support your business journey at deeptechnation.ch. Again, that's deeptechnation.ch.
And so this is also something basics in finance. You don't want too much money, okay? Because if there's too much money, then the VCs will have to invest this money. And when the best startups are already off, then they'll have to go down the pool and start investing in startups that might not be the most promising. And so this is not really good. Okay, so not enough money is not good. Too much money might actually lead to some distortion as well.
Welcome to the Swisspreneur Show, a podcast about startup stories and learnings from experienced entrepreneurs. If you enjoy listening to our show, make sure to follow the podcast and leave a rating. And now, here's your host, Merle.
Welcome to another episode of the Swisspreneur podcast. Today I'm sitting here with Laurent, who is a professor of finance at the USI, so the Università della Svizzera Italiana, and the Swiss Finance Institute, as well as a pension fund board member. First of all, welcome, Laurent. Thank you for being here.
Thank you for having me here. It's a pleasure.
Your research has been published in several leading academic journals. Can you tell us actually more, maybe your background, where you come from, and also what first interested you in the finance world?
Yes, sure. So as you can guess from my accent, I'm from the French part of Switzerland. I'm from Jura, from the Jura Mountains. So I grew up in a very small village in les Franches-Montagnes. And then I got interested in finance, I would say really randomly, because after high school, I really wanted to do chemistry. I had a passion for chemistry. And so my plan was to do chemistry at EPFL. Mm-hmm. But then for various different personal reasons, I missed the deadline of the registrations. And so in July, the only university that would accept me with a high school diploma was the University of Neuchâtel. So I went there. Mm-hmm. And so I realized on that day that they didn't offer chemistry. So I signed up in economics, really, thinking, well, this is just for 1 year. So let me do something that I have no idea about. Mm. Because I didn't do any economics when I was in high school. I was in the science track. And I signed up for economics, and then I remember, I think it was in December of the first year, on a foggy day in Neuchâtel, you know how December days could be in Neuchâtel, in a microeconomics class, then the professor told us about asymmetric information and moral hazards and incentives. Mm-hmm. And I still remember that day in a very crisp way, because I was like, wow, this is really interesting. And since that day, I got that in my mind. And I realized that, asymmetric information incentives is everywhere. And it explains a lot of the things we do when people, exchange, trade, do business. And it also explains a lot of the problems and failures that we see in markets in general and in financial markets in particular. Mm. And so 4 years later, I'm still doing research and understanding the world through the lenses of these concepts. So that's my initial love for finance came from this foggy afternoon in Neuchâtel.
So you got hooked by an accident.
Absolutely, yes.
Very much. That's a great story.
I always wonder whether I would have been a good chemist. I don't know. Maybe.
Who knows? In another life. Before we go into depth, because today we want to talk about Swiss VC funds and if they should raise money from the Swiss pension funds, maybe we should explain some fundamentals. Can you walk us through workings and processes of VC funds and pension funds, so we all have the same baseline?
So maybe the best way to have a super simple introduction to this world of VC investing is to imagine a world where you have many different startups. Mm-hmm. Okay, some of them could be coming out of the great universities that we have in Switzerland. So you have all these young founders that develop great ideas and product. And so they need money to scale, they need money to grow. And on the other hand, you have people with money. And people with money could be individuals, but most of the time there will be institutional investors like pension funds that are in charge of managing and growing the money for insured people. Okay, so you have these two groups of actors. You have the entrepreneurs that are looking for money, and you have these big institutional investors that have money and are looking for investment. So the challenge for these institutional investors is to figure out in which startups they would like to invest, because their objective is to get return, because they want to ensure sustainable pensions for future, present and future retiree. And so this is very difficult for them to do. And so in the middle, as an intermediary in this world, comes venture capital funds. So venture capital funds will raise money from the investors and will invest the money on behalf of these pension funds or other investors into these startups. And so they do that because they have expertise. Most of them are previous entrepreneurs, or they worked in startups. And so you have to realize that this is very difficult to do, because when you think about a startup, this could just be, a few people with an idea without any profits yet, maybe just in a garage. I mean, it's a bit of a stereotype, but sometimes it's like this, in a lab at a university. So it's very difficult. So you need a lot of expertise and dedication to pick the ones that are going to be successful. And so the VC world is making the connection between people without expertise necessarily, or time, or willingness to specialize in this business, and the startups that are in looking for money. So in a sense, they do play this intermediation between the institutional investors and financing of ideas, which is very important, because if they're not there, it's very difficult for startups to raise money.
Yeah.
And the reason being that, as I said before, most of the times they have nothing tangible yet. And so they cannot really, knock the door of banks and say, oh, we would need a loan to finance our ideas. This is very risky for banks to do that. There's nothing they can collateralize. There's nothing they can pledge. Yeah. And so you need people that are willing to take risks, because this is a risky business, and venture capital are specializing in risk-taking business.
And maybe also to add, of course, the people that give the money to the VC funds say, look, here, I give that money and I know it's a risk, but I would like to have a return in X amount of years.
So, as I said, the objective and the job of pension fund is to, collect the capital that every employee and employer contributes to, and grow this capital in a sustainable way, meaning by managing risks, so that you and I, when we're older, we get a decent pension. And so in order to do that, of course, they need to take some risks, because if they don't take any risk, there's no return. Okay, so this is basic finance 101. They don't want to take too much, because they don't want to gamble with your money and my money. And so they need to have this very prudent approach. They need to use diversification. So that's why it would be very dangerous to put everything into venture capital.
Mm-hmm. Yes.
It might be silly to put nothing into venture capital. We might maybe discuss that later. But it's important to understand that the job of pension funds is really to make sure that you and I and the listeners that are working in Switzerland have sustainable pensions for their future.
And now we already touched upon the topic that we want to talk today. So we know that in 2022, Switzerland introduced a new investment category, actually allowing pension funds to allocate up to 5% of their assets to unlisted Swiss investments, which that also includes venture capital. First, what was the rationale behind that decision?
Okay. I don't do politics, so I'm not sure about the rationale. So what we need to remember is that, before 2022, it was possible to invest in VC funds. So it fell in the category of alternative investments, together with investment in some commodities, hedge funds and so on, infrastructure. And so it was possible to do it. So what's the change in law, or the addition of this new condition, this 5% into private equity or private debt, is, I think, to raise awareness of that there is this category of investment that's possible, and also to clarify, because if you read the law, this 5% comes with some strings attached, meaning that this means that you need to invest in an entity that is located in Switzerland. And you need to have at least 50% of these investments that are invested in Switzerland. Okay, so this means that you could not, under this umbrella, invest in US VC funds that exclusively invest in Silicon Valley, for instance.
Yeah.
Okay, for that, you will still need to go through alternative investment. The additional item on the law is that in this 5% category, these venture capital funds or these private investment funds cannot use leverage, meaning that they cannot borrow money to increase the size of their investment. Okay, so this is to make sure that if we have entities like pension funds increasing their allocations to this specific category, they want this to be in a risk control environment, meaning diversified, in Switzerland, meaning complying with Swiss laws and regulations of disclosures and so on, and affecting startups in Switzerland. And so that's why you have these conditions. I don't think this is too binding. I think this makes a lot of sense. But this is good because with the law, first everybody talked about it. Oh, there's this new category that we might consider. So every board member on the 1,400 pension funds in Switzerland, maybe a bit less, know about it. And so those that had no idea about private debt or private investment say, oh, what is this? So this is good, I guess. And the other one is to make sure that this is done in an environment where risk is controlled. So this is my interpretation.
And if we look at the numbers, though, we can see that the uptake has been rather modest, I would say, in comparison also to other assets.
Yes.
Why do you think that Swiss pension funds invest so little in venture capital?
Okay, this is a great question. I'm not sure I have the answer. Maybe before, let's put things in perspective.
Yes.
So as I said, there's about 1,400 pension funds in Switzerland, managing roughly, it depends because, the market is up and down. Let's say to simplify 1 trillion Swiss francs, so 1,000 billion, so it's a lot of money. Most of it is invested in bonds, stocks, real estate, and cash. The fraction allocated to private equity in general is about 2%, a bit less than that, 1.5%.
Yeah.
We don't have clear numbers about VCs, but it should be around 0.2, 0.3%. Okay, so we have let's say 1 trillion Swiss francs managed in the pension fund system. And if you look at the latest numbers about the amount of money that is invested through VCs into Swiss startups, it depends on the year, let's say 3 billion a year. Okay.
Yes.
So of course, in these 3 billion, this is not only pension fund money. So we are in the vicinity of 0.2, 0.3% of the big portfolio of pension funds with Switzerland allocated in VC, which is very small.
Yeah.
Which is very small. So there are many potential explanations for why this is small. One is it's small because we don't have promising startups in Switzerland. So I think this is very easy to rule out. We have lots of interesting startups in Switzerland. Yeah. The proof is that many of them, they have to leave Switzerland to get access to money. So they would go to the US, some of them would go to Israel, some of them would go to places where it's easier for them to raise money. So we can cross this one. Another reason why pension fund might not invest in VCs or directly in VCs could be that they don't know about it. So there's lots of or a big lack of literacy about what are VCs, what they do, what are the risks involved, and so on. So keep in mind that the venture capital business is an old idea, but not that old. Okay, so Silicon Valley is not that old, so it was not there like for 200 or 300 years, unlike investing in stocks and bonds and so on.
Yeah.
So it's a new concept, especially in Switzerland. Okay, so I remember when I studied finance at university, we never talked about VCs or private equity. If you look at the courses offered in Swiss universities, in finance programs or econ programs, you will start to see in the last 5 to 10 years courses on dealing with VCs and private equities and so on. So it takes time to build knowledge and to build awareness about this asset class. Another possibility, which is very simple, is that they know about it, but they just don't like it. Okay, I cannot exclude that. That's a possibility. I don't think this is the main driver. I think this is a mix between the lack of appetite for risk taking, and the lack of knowledge about this asset class and the ins and outs of this asset class.
But how would you say that pension funds typically assess risk?
I cannot speak for all the pension funds, so I can speak for the ones I know and the one I'm involved in. We assess risk in different ways. Most of us in the pension fund world, we will use consultants for two reasons. One, because they have expertise, and the other one, because they provide a shield towards liability. Okay, so this is easy to blame somebody else if you make mistake. And so we typically assess risks looking at historical data. So if you want to assess the risk of a stock investment portfolio, of a bond investment portfolio, of a real estate portfolio, what we would do is to say, okay, let's look at historical fluctuations, historical exposures, ups and downs, and we can use different types of measures of risks that have been developed in practice or in academia. So this is relatively easy to do because we have lots of data. Mm-hmm. Because the securities, stocks, bonds, and so on, they are publicly listed. And so we have mark-to-market value, so we can observe a lot of things. Firms have to disclose information, so they have to tell you what they do, where they operate, the profits they make, and so on. So there's a lot of information. So assessing risk in investment in private markets is much more difficult because we don't know much. Okay, so if you ask me about a specific startup, for instance, you can tell me the name of the startup, the name of the founders, but that's about it. Mm-hmm. You know, if I'm not an investor or if I'm not somebody close to that startup, I don't know much about it, so it's very difficult to assess the risk. And so same thing for venture capital. We have different types of venture capital funds operating in Switzerland. Some of them are relatively big. Most of them are small, so it's very fragmented. And so as an investor, we are facing a market for VCs that is not so deep, very fragmented, and we don't have a lot of information on them. Okay, so if you randomly go on the website of some of these venture capital funds, you will see the team, you will see who is the founder, who are the partners, and so on. So it gives you information about, their abilities somehow. You will see information about the companies they invest in. Okay, so you have their portfolio, but that's about it. So you don't really know their performance. You don't really know whether they're doing well. Of course, if you consider it as an investment, okay, you're a big pension fund and you're interested in investing with them because they might need money at some point. They will probably open their books. But they can show you whatever they want. There's no disclosure standards. There's not the law that requires them to disclose you or explain to you the performance in a specific way. So this is very opaque. And so this might explain why some pension funds say, well, there might be huge opportunities in this business, but this seems opaque. I'm not sure I want to spend the time and make the effort to take this risk.
That's interesting.
And so this is also probably because of a lack of understanding of what's going on.
Yeah.
What's going on under the hood.
So what would you suggest to pension funds to add certain employees with certain knowledge, maybe past people that have worked in funds, or also maybe what kind of networks could they tap into to learn more about this?
So that's a good question. So I forgot to say something. Maybe another reason why, and so this is related to your question, so that's what it comes to mind now. One of the reasons why they might not necessarily go after venture capital is that in the law, board members and managers of the fund, they need to show that they have the skills necessary to make the investment.
Okay.
And so I think there's a legal case to be made if, for instance, a board of a pension fund decide to go, all in VCs without any understanding of what's going on, they might face some liability there. Mm. And so it could also be the case that they say, well, in order to get to the point where we would understand what's going on, we would need training, we need to think about it, we need to hire, consultants that are rarely independent. We might come back to that. And so this is a problem. So, even though we need to give up some expected returns and some diversification, maybe this is not worth the effort. Mm. And so to answer your question, one thing that I would recommend is to first think about it and maybe ask for help in a sense of basic training. Yeah. What I realize, when I go around in different events that are, connecting VCs to institutional investors, and we see more and more of those happening, which I think is good, is really a lack of understanding of, the internal dynamics, the economics of VC investing, and the assessment of performance, which is not so easy to do. And so it's very important, in finance, to follow the money. You need to follow the money. Okay, so there's a bunch, some money leaving the pocket of someone, entering the pocket of somebody else. And so in this journey from one pocket to the other, there's lots of layers and intricacies that sometimes are difficult to follow. And given the opaqueness of these markets, this is kind of tricky to follow. And so I think it's important to have clarity on that, to demystify a little bit this VC world, and to make sure that everybody understands.
Mm-hmm. And you mentioned just now also the legal aspect of also the liability maybe for the funds. What are, in your opinion, generally the biggest regulatory barriers with the frameworks that we have? Do they also present barriers for the funds?
I'm not so sure.
Mm-hmm.
I think the regulatory barrier would kick in if somebody wants to invest a large amount in venture capital funds. But otherwise, I would not, of course, if you think about a balanced portfolio allocation for a pension fund that has, the objective of growing capital in a risk-controlled environment, you can probably run any asset allocation model with any assumption you want. Given the historical track record of different asset classes, it will never come out of the model that you need to invest 50% in private markets. No, it will probably come out of the model that the optimal allocation, depending on the fund, the demographics, the objective in terms of returns, the risk they're willing to take, it's probably above zero for sure. So I would say anything between 0 and a few percentage points would be good.
Mm-hmm.
So now, in terms of legal constraint, I think this is fine. As long as, remember, the law says that it has to be diversified.
Okay.
And so this means that what I would recommend pension funds to do or to not do, if they are thinking about investing in venture capital, is to not go with one fund. Because what we've observed, if you look at the academic literature on the performance of private equity and venture capital funds, what doesn't work is when institutional investors invest with local funds, because they are friends of friends, cousins, network-based, politically based. And so this typically leads to subperformance. And so I think it would be important for a pension fund to say, okay, let's be serious about deciding on allocating a fraction of our portfolio to VCs in Switzerland, do it in a balanced way. So diversify across funds, diversify across vintages. Vintages means that, when a venture capital fund is created, they will get money from investors at a given point in time and start investing with a given horizon of investment, typically 7-10 years. And so new funds are raised every year. And so, of course, you don't want to put all your eggs in the same basket. So it would be silly to invest once in VCs, because you will be very exposed to one cohort, and maybe this is not the winning cohort. Okay, so you would diversify optimally across cohorts and across funds. So now, of course, this is difficult because, as I said, the market for VC funds in Switzerland is very fragmented. So this means that you'll have to go and do due diligence and meet all these people and try to figure out, who are the good ones and who are the less good ones. So this takes a lot of time and effort. And so this is also maybe why some pension funds says it would be great to have an allocation in VCs. We don't want to be undiversified. We don't want to go with the cousins or the brother of the local politician, even though they push us to do that. And so we'd rather not touch than doing it in a bad way. And so if that's the reason, I think that's reasonable.
And how does Switzerland actually compare to other countries in terms of allowing pension funds to invest?
So now I think it's on par. Of course, if you look at the US or other European countries, you will find pension funds with very large allocations in private markets.
Yes.
Not only VCs, but private markets.
Mm-hmm.
Some public pension funds in the US managing money for public employees would have allocation up to 40-50%.
Oh, wow.
Which is very big. So in Europe, this is much less the case. So you have some countries that are more invested in VCs and private equity. The Netherlands, for instance, is one. The northern countries are another one example. But I think that with this, this limit at 5%, or you can go above, reaching this alternative investment of 15% if you want to have funds that are levered and so on. I think this is not very restrictive. So now also keep in mind that, of course, we have lots of startups that are promising in Switzerland. So if you have, say, in an hypothetical world, all the pension funds in Switzerland investing 10% in VCs, we're talking about 100 billion. I mean, we don't have startups worth 100 billion every year in Switzerland. And so this would be too much. Okay. So you also don't want, and so this is also something basics in finance, you don't want too much money. Okay, because if there's too much money, then the VCs will have to invest this money. And when the best startups are already off, then they'll have to go down the pool and start investing in startups that might not be the most promising. And so this is not really good. Okay, so not enough money is not good. Too much money might actually lead to some distortion as well. So don't ask me what would be the optimal points, because because I actually don't know. And so the reason we don't know is we don't have data. We just don't have data. So
I was about to ask like what the historical data says, but
I wish I could answer that. But for instance, if you ask me what has been the performance in the last 10 years or 15 years of Swiss VCs, I don't know. I know some of them that have done very well. Those that don't do that well, we don't know much about them, right? So it's very rare that people brag about their failures, and so it's very difficult. It's very difficult to have good information on in a systematic way.
Hey, did you know that Swisspreneur just published a book? That's right. We've spent the past year writing Swiss Startups, a compact view of some of the most amazing startup journeys in Switzerland, from scrappy beginnings to world domination. If you love listening to our podcast, then this is about to become your new favorite book. Find it now in all major bookstores or click the link in the show notes to order your copy from Helvetic today.
do you think that there is a risk of like over politicizing pension fund investment decisions because they're connected and support national innovation?
Yeah, I think that's a risk.
Mm-hmm.
It's a risk and an opportunity.
Yeah.
So it's true that if you take some distance and you analyze Switzerland, you would find a little bit of an inconsistency or a missed opportunity, because as I said, we have very good universities and polytechnical schools and technical schools. And so this produces a lot of good innovation, lots of talented people, lots of good jobs. And so most of it is financed with taxpayer money.
Yeah.
Okay, so the government chips in different forms, in different shapes. And so when the government chips in, this your taxes and my taxes and everybody's taxes. And so this is potentially a very good way to run a country because it provides a lot of return.
Yep.
At the country level. And it's not just randomly that Switzerland has the level of wealth and the level of development that we see today. And so there is a large amount of taxpayer investment. And so this produces a lot of startups. And as I said, some of these, at some point, when they really need to access large chunk of money to really develop and become big and make an impact, they don't find it in Switzerland. And so they have to go somewhere else. Or they need to sell to investors from different countries. And so very often, not always, but very often, this means that all these investments that is financed by taxpayer money is not paying off in Switzerland. It's going to be paying off somewhere in the US, maybe in Israel, somewhere in other European countries. So we lose that. And so it's a pity because we're talking about Switzerland. So we're not short of money. Okay, so if you look at all the wealth that is held in the pension fund system and outside of the pension fund system, but just sitting in banks, managing money for wealthy clients from all over the world, we're not short of money. Okay, so I think there's this bit of inconsistency or this lost opportunity where there's a lot of initial investment, and so we don't reap the full benefits as a country of this investment because we're missing a stage in this process, which is financing growth of these successful startups. And so this is where I think there's a bit of a political will to say, well, it would be a good idea to narrow this gap and to use some of the money available to do that. Of course, it's not the government's business to do that. The government business is not to really support and subsidize the growth of Swiss startups. But there is a bit of a gap. And so the push is to say, the political push is to say, oh, you have all these pension funds that are sitting on $1 trillion of Swiss francs, so maybe they should breach part of the gap. And so I understand this view, but we don't have to forget that the main objective of the pension fund, as I said, is to make sure that retired people and future generations of retired people have the ability to have a decent standard of living in pension. And so the objective of the pension fund system is not to do industrial policy. Yep. Is not to intervene in markets and correct a failure that is generated by lack of coordination or lack of vision. And so I think if the pension fund can help by achieving their objective, which is to grow capital for their people, I think this is fine. If the push is too strong, there is the risk that this becomes an instrument for industrial policy, and so this is dangerous because this could backfire by lowering a little bit the capital growth of pension funds. Given the numbers that we're talking about and what Switzerland would need to make sure that their best startups don't leave, I don't think this would put the pension fund system on its knees. I mean, we're talking about small amounts, no? So if I told you before, now we are at maybe 0.2, 0.3%. Yep. If we double that, so this would mean a few 3-4 billion a year. This would be good for collapse for the financing of Swiss startups. So this would put 0.6-0.7% of pension fund wealth. I mean, this is not enough. Yep. This is not big enough a move to make a significant downside on their wealth. But again, finding the right tuning of how much, under which circumstances is difficult. But I think the least political intervention there is, the better. I think the market has to realize on its own, and the pension fund world, the startup world, the financial sector in general, that there is this funding gap. And so it's silly to leave money on the table and to give this opportunity for other countries to grasp.
And do you believe that the 5% cap is sufficient? Too low, too high? Is it to have this meaningful impact?
Yes, I mean, so, if we go to 5%, so that's a lot of money, maybe too much. So I wouldn't necessarily advise to reach this 5%. Also, keep in mind that this 5% is not only private equity, it includes private debt, it includes other type of instruments, and I think it's a benchmark to give some flexibilities. Of course, you have to keep in mind that this is not an average number; it's a binding number for every fund, and so then we need to understand that there's large heterogeneity across funds. So these 1,400 funds, some of these funds are small, some of these funds are large. Some of these funds have very different demographics. Okay, so it's very different if you insured very young people. They are going to pay in for another 30, 40 years, and you have almost no one that you have to sustain in pension because everybody's young, as opposed to a fund where most of the money is used to pay the pension. And so the level of risk-taking that these two extreme scenarios is very different. Yep. Okay, and so I think the 5% gives the flexibility for the funds that have the capacity to take some risks in order to generate returns, to do that in the private markets. In my opinion, this is enough.
Mm-hmm. And what about the idea of a VC fund of funds system? Like, I think it's called Swiss Future Fund that's been proposed. Yes. Can you first explain to us what that means, what it is, and how it could help pension funds?
Yes.
Possibly?
So, a fund of funds is another layer of intermediation. Okay, so think about the market for VC funds in Switzerland. As I said, is very fragmented. You have some of them are big, some of them are small. And so imagine a pension fund investor. They say, I'm looking at this market. I have no capacity to understand which are the good ones, which are the not so good ones. So I'm going to delegate this task to another fund that is called Fund of Fund. And the task of this fund is to select for me the VC funds that are going to select the startups. Okay, so it's another layer. And so this could be a good idea because, as I said, there is not a lot of expertise for the pension funds to actually select some of these VC. Some of them do that very well. So they have a long experience. They have very good professionals that have worked in this area in the past. But for most of the funds that are small, they're not going to hire or they're not going to build up a team dedicated to this investment. So for them, it could be a good idea to have access to vehicles like fund of fund. They do the selection for them. It would be good because it spares the time and effort and cost of doing the selection, and it could provide a diversified product across funds, across vintages, as I explained, which could be efficient. So if this is done in Switzerland, this could also be attractive for pension funds because this would be in line with regulations. So this would be compliant with the type of legal structures that pension funds can invest in and so on. This would be generating returns in Swiss francs, okay, which is also good because if go now and invest in VC funds in the US, you get returns in dollars with the recent fluctuations, for instance, in the dollar Swiss francs. This is not. This is something that you need to take into account. So I think investing in Switzerland is also one way to limit risks in the exchange rate market. And so this could really facilitate the attractiveness of investment in VCs. Of course, this comes at a price because VC funds are expensive, and a fund of VC fund is even more expensive. Okay, so I think it would make a lot of sense. I think many pension funds would be interested in that. They would be willing to pay a price in order to have access to a diversified and competently done fund of fund, maybe a few of them. Okay, so it would be good to have competition. So this could be optimal. So now it's also important to realize that VCs are expensive. Okay, so a typical deal for a pension fund or an institutional investor in a VC fund is the so-called 220. So meaning that if you're a pension fund and you decide to allocate, let's say, 100 million to a VC, then you commit this 100 million. And so this 100 million could be called anytime. Okay, so this means that the fund will have a 10-year horizon. And at some point, when this VC fund has found a startup or two or three, they will call your money. And at that point, the money is leaving your pocket, going into the fund's pocket, and going into the startup pocket. And then at some point, hopefully, the startup will grow, and the fund will be able to sell the participation in the startup, either taking the startup public through an IPO, or selling to another company or to another fund. And then the money will flow back into your pocket. Okay. And so the 220 means that out of the 100 million that you committed, the fund takes a 2% management fee. Okay, so 2 million a year that you have to pay to the manager of the fund in order to select and intervene with the startups. It's important also to underline that the job of the general partner of a venture capital fund is not only to select startups. They work with them, they help them grow, they are on the board, they connect them, they find the right people to run the startups and so on. So this is also business development. So it's not just selection, there's also treatment that is important. But you have to pay this 2%, sometimes less. Okay, but the general rule is 2%. And then the fund will keep typically 20% of the profits.
Yep.
So imagine that out of the 100 million, the fund calls 10 million after 1 year because they've found this nice startup to invest in. And then a few years later, they sell this participation for 50 million. Okay, so there's a 40 million profit. So they will take 20% of that. Mm-hmm. You keep, as the limited partner, the pension fund, you keep the difference. And so that's why I was saying it's important to track the money. Mm-hmm. Okay, and so of course this is much more expensive than typical bonds or stocks products. Right? So if you're a pension fund now and you want to invest in a fully diversified, worldwide passive fund, you're going to be charged a few basis points a year compared to 2% plus leaving up some profits. Mm. And so this also means that the expected return on this investment should be big. Yep. To make sense and compensate for one, the risk that is involved, and two, the cost that it involves.
Yeah, and with a fund of fund, you can then imagine that fund obviously also takes these percentages
I would imagine
to keep themselves alive.
They don't really work for free.
Yeah.
So there might be, the fees might be contained, and so if they're big enough, and if they're serious enough, they could also get better deals by investing in these VCs than the 220. Mm-hmm. And so at the end, I think if this is done properly and And in a controlled environment, I think this could be done in a cost-effective way. Let's see.
Interesting concept. And what's your take on co-investing from like with Swiss pension funds who co-invest alongside larger institutional investors?
That's a good question. If you look at the law is clear that investment should be diversified.
Yes.
So I think if a pension fund decides to unilaterally invest a large chunk of money into one startup, either directly or as a co-investment, it doesn't really qualify as a diversified investment. So, I mean, if they do that across the board, it's fine. But again, I think for pension funds to do that, they would need a proper team that has the competence and the skills to evaluate these funds. And so I think it could be possible, but I would only advise that to large funds. I cannot imagine what I would classify as a small fund, maybe a few hundreds of millions under management to start co-investing with these startups. Because co-investing is typically not enough. You need to also be part of the firm and so on and so forth. And so this means more work and more effort for the manager of the fund. So delegation as a bright side is that you delegate. Of course, you delegate the work.
Yeah. Do you want to tell us a little bit, because we got to this podcast in the first place through DeepTechNation. Can you tell us about what they do, of course, and maybe also how they could play a role here?
So DeepTechNation, yes, it's a great initiative that is recent, and that has the objective of, I think, connecting people with money in Switzerland with all the bright founders and innovation in Switzerland. So they realized that there was this funding gap that led some of the startups that we develop to fly away. And so they realized that this was silly. And so this DeepTechNation is this foundation that is sponsored and backed by some of the largest companies in Switzerland. You can go on the website and look at the names. And so with the objective of, one, providing information on this ecosystem, connecting startups to investors, to VC, to universities and innovation hubs. And so this is very useful. Two, to help investor through maybe the creation of together with some financial institutions of funds of funds, and so on. So they are in the process of doing that. And so this is promising. And also with the objective of disseminating training and information for pension funds, for instance, but not only, in order to raise awareness about the risks and potentials of this asset class and the legal structures, the legal constraints, the things that we need to be careful with, and so on. And so this is a fascinating project. And so I think it's very good because it's not politically funded, or it's really the market, some of these big companies realizing that there is a failure and willing to correct this failure using a light touch, meaning information, training, networking, putting people together step by step in order to build something that helps the country, that helps young people. If that could also help pension funds by generating some returns, this is also good. And so this is an initiative that is taking off and to be followed.
Yeah. I'm very interested to see generally how this topic unfolds and the discussion unfolds. I wonder, do you think individuals should have a say in what the pension fund that their money goes into is invested in?
That's a good question. It's almost a philosophical question.
Yes.
Should they have a say? Well, let's consider why they should and why they shouldn't. Okay, so the way it works in Switzerland is that, unlike other countries, or in some other countries, so your pension fund money is not under your control, meaning that you work for an employer. The employer, by law, has to be affiliated with a pension fund. And by law, he has to be affiliated with one. The employer can freely choose. And then this pension fund provides a pension plan. And then your employer agree on the plan, and means that every month, depending on the plan the employer chooses, will put some money on your behalf, and you will have to put also money on your behalf. So you can have a very generous employer that puts much more money than you, or you can have not so generous employer that put the same amount. The law implies that the employer should put at least the same amount as you. And so this means that as an employee, you don't have any choice. And so you are affiliated with the fund, and the fund is managed by some people. There's a board of the fund. They decide on investment. And so if you're lucky, they do a good job, and they generate good returns, and they don't take too much risks. And so if you're not so lucky, they don't generate a lot of returns, meaning that the capital that you provide, in every paycheck is not growing that well. And so it's important to realize that if the pension fund takes too much risks and this risks materializes, the pension fund becomes underfunded, which means that the liabilities that they have in terms of paying the future pensions is higher than the assets they have. Okay, so they don't have enough money to pay for everybody. And so if that happens, this is for the employer and the employees to chip in and bring more money, because you cannot touch the retired people. Okay, so the ones that go in retirement, you cannot ask them to give the money back. Okay, so it's very important for pension funds to not be underfunded. And so this means that for when you're an employee in Switzerland, you can be lucky or not to work for a generous employer that contributes a lot on your behalf, and also be lucky to be in the hands of a pension fund that is managed well, that is investing rationally and prudently, that makes reserves and they generate returns. Mm-hmm. Okay, so the returns that they generate is important because this is the way the capital grows over time. Okay, so if you can make the calculation. If you have a given amount that you put every year, and your pension fund generates a return or pays you a return of 2% versus 4%, after 40 years of contribution or even 30, they're going to be a huge difference in how much money you're going to get in pension. And so this means there's going to be a huge amount of money in your standard of living when you retire. And so, yes, Swiss people or Swiss employees in Switzerland, they don't have a choice. Or they have a little bit of a choice. They could say, I'm not going to work for company one because I don't like the pension fund, so I'm going to instead work for company two. I don't know many people that do that. Most of the time, they don't even know. Yep. So on their first day, they have to sign a few documents, and one of the documents is, give me some information to affiliate you in the pension fund, and that's it. They don't bother. They start bothering, or they start getting information when they are close to retirement. After 57, 58, they say, I wonder how much I'm going to get in retirement, and very often say, I expected much more than that. So they don't have a choice. And so the alternative would be, like it is in the US, for instance, in some companies, is that your employer will give you a choice of investment within the pension fund. Okay, so I can give you an example. I used to work in the US at the University of Maryland for 7 years. And so I was contributing to a pension fund. And so the university was contributing for me. And so I had full discretion on how I wanted to invest this money. Not full discretion, but this money was with a very large asset manager. And within the University of Maryland system, I had the opportunity to invest across, I believe, 80 different portfolios, from zero risk-free rate, to high risk. And I could manage my retirement investment the way I wanted. And I still do. And so to answer your question, so this is one extreme. Mm-hmm. And the Swiss system is another one. So of course, if you have people that are finance professors or finance professionals, probably they would rather manage their money themselves. I think that the difficulty is that many people don't really know how to invest. They don't want to know how to invest because this is risky. They don't want to take any risk. And so if you let people decide on their investment, probably you'll have extreme results, meaning that some of the people are very risk averse, so they will not invest in anything risky, so their capital will not grow at all. And so they will end up in retirement with a little amount. And then on the other hand, you will have people that like to gamble, and they will take a huge amount of risk. Some of them will be lucky and the risk will pay off, so they'll end up with a good amount in their retirement account. But for some others, the risk will not pay off, and so the gamble will backfire, and then they will end up with very little in their pension fund. And so what is important to realize is that in European countries, we typically don't leave people dying in the street, meaning that if somebody loses everything by investing his pension fund money, the state will have to pick up the tab. Okay? And in order not to do that, I think the state has decided to not let this option.
Yeah.
In the US, where the philosophy is very different, everybody is in charge of their own investment. If it backfires and they load up on risk why they shouldn't, too bad for them.
Yeah.
So the safety net is much less present. And so within the context of Switzerland, given that we have this state government backstop, I would think that overall it makes sense. So there is the opportunity to opt out under some very specific conditions. So maybe it would be an idea to think about, to relax a little bit and to say, well, if you are an employee and you contribute to your pension fund and you have some ability to invest your own money and you have an income that is sufficient for you to not load up too much on risky bets, maybe we should give this flexibility. It exists a little bit, but it's very restrictive. But this is not something I would fight for very strongly.
Yeah. And like you said, I mean, there's the opportunity with the third pillar, for example.
Exactly.
Where you can also gamble if you
Yes. Well, this is also, I mean, these notions of having more flexibility on your investment in some sort, it's a problem, but it's really a problem for rich people. I think for most of the country, this is not really a problem. So which also means that it's very important for the pension fund system to be performing well. Given that there's very flexibility, it's important for them to generate risk-adjusted returns that are good and that are sustainable.
And if we look a little bit ahead into the future, do you expect that the Swiss pension funds will increase VC allocations, I don't know, in the next 5 to 10 years? And do you think there's something that needs to happen to drive that shift?
I think this will increase. I typically don't make predictions, so this is not a prediction, so this is more of a thought. My thinking is that this will increase for good and bad reasons. Maybe let me start with the good. The good reason is that we're in the business now of reaching for yields, so we need returns. And so, safe assets in Switzerland or in some of the developed countries, if you adjust for exchange rates, they're not, paying a lot. And so this has pushed pension funds towards more risky assets, in stocks, in real estate, or in private markets. And so I think this will continue. And so this will also push pension funds in Switzerland to tap into this new world and understand that there is, money to be made in a risk-controlled environment. And so this is good. The other thing that is probably going to happen is that if you look at stock markets all around the world, the number of publicly listed firms is decreasing. But just in the US, in the mid-90s, there was more than 8,000 companies listed. Now it's less than 4,000. Okay, so the market is shrinking, not in market cap, but in number of companies. And so this is because there's so much money in private markets. So now you can be a startup and stay private almost forever and reach valuation in the billion. And so what it means that compared to 20 years ago, where startups went public very early, pension funds and investors like you and I could benefit from the growth of these companies by buying them in the public market while they were still young. So nowadays, the successful startups, they go public very late when most of the growth has already happened. So this means that if you really want to benefit from that growth, you need to invest early and through VCs or other vehicle. And so I think many institutional investors are realizing that now. And so this could push them to invest more into this type of assets. The counterpart of having a decreasing number of publicly listed firms means that it's more and more difficult to have a diversified portfolio of stocks. And so there's huge concentration, particularly in the US. So most of the portfolios of institutional investors, they load heavily on US stocks because they have high valuation. And so because there's less and less assets, stocks to invest in, this means that if you want to diversify and be exposed to the large swath of the economy, then this is increasingly difficult to do only using stocks. And so this pushes you naturally in a diversification perspective towards private assets. So this is for the bright side in a sense. The dark side could be that there is an increased allocation to VCs simply because it's cool to do that. And so it's true, I have to admit it. If you sit in the board of a pension fund, some of the discussions are interesting. Some of the discussions are not that interesting. And so, thinking about investing in a broad, passive fund in stocks worldwide that is, including 6,000-7,000 stocks, is not super, it's not super interesting. Discussing about the next startup developing the cool AI technology, this is much more interesting. And so I think there's also this psychological aspect where in Switzerland we like entrepreneurs, we like manufacturing, we like to do things, we like innovation. So we'd like to invest in these sectors much more than going passive and so on. And so this is good. This could push towards making good investment. This is also dangerous because this could lead to investing with fads and bubbles. And so I would warn pension fund managers or pension fund boards to say, okay, don't go with the hype and make sure that you understand what is being invested in and the dynamics and the economics of it. And so overall it's fine. You don't want to go and heavily invest in assets they're gonna be losing a lot of value. And so I think it's gonna go up. I wish it goes up because I still believe that there's lots of opportunities for pension funds in this area. I think that this moved toward more information, for instance, through DeepTechNation Switzerland is extremely helpful. But I still, there's no free lunch and there's never any free lunch except maybe diversification in finance. And so this still needs or requires a balanced and risk control approach, as I said, with more information, more training. And maybe this is our job as universities also to step up and say, look, we have competencies. And so our mandate is also to reach outside of universities and provide our services in order to make the flow of information and the flow of knowledge about this type of assets flow better.
Yeah. And I want to finish with one more open question. If you could change one thing today, right after this podcast, that would unlock more Swiss pension fund capital for VC, what would it be?
The one thing I would maybe unlock, but of course I'm biased because I'm a researcher, I'm an academic. I'd like more data. I'd like to have more data. I'd like to have more transparency in these markets. And so I think this would be great for everybody if we had more transparency on performance, on fees, on the way the sausage is made really within these funds. This would be a way to unlock potential because if it's more transparent, there's more trust. People know what they're investing in, and so this would be one way to unlock the potential and convince pension funds that they can trustworthily invest and make a step towards this world. This is not the case yet. I'm not sure that we are in the process of having more transparency, not only in Switzerland, everywhere in private markets. Remember, I got interested in economics and finance because of asymmetric information and incentives. Private markets is a place where information is hugely asymmetric. Incentive is tricky. Remember 220 compensation. You're going to have some fund managers, they're going to have incentives that might not necessarily be aligned with those of the investors, the pension funds. And so I think it's important for everybody to see through these fog. And yeah, I would wish for more data and more transparency.
I think that's a very important thing. And I think also it gives people more confidence to go in that direction.
Yeah, absolutely. It's difficult to make any type of business if you don't trust.
Yeah.
No?
Exactly.
And so it's difficult to trust without information.
Yeah. Well, thank you so much, Laurent. This was a super informative session. I really loved it. And I thank you so much for your time and guiding us and our listeners through this topic and making sure that we all have the information that we need. So thank you so much. And I'm looking forward.
Thank you. It was a pleasure.
Maybe talking in 5 years and seeing how it has evolved.
Yes, absolutely.
Thank you very much.
Thank you.
We hope you enjoyed today's episode. If you did, you can support us by rating our show on Apple Podcasts. This way, we can reach an ever-growing number of aspiring entrepreneurs.